Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening in the UK economy. If you've been following the channel, you'll know that the UK has been suffering from persistently high levels of inflation. And as a result of that, the Bank of England has introduced 14 consecutive interest rate rises. And those interest rate rises have had an impact. In the period between March and July, inflation has come down from 10.1% to 6.8%. So things are moving in the right direction, but they're not moving quickly enough. And the Bank of England's target rate is 2%. So 6.8% is a long way away from that. So the UK is still trying to bring prices back down. But the latest data that's now been released shows that the UK has a major problem with regards to wages. In the period between May and July 23, total wages increased by 8.5%, and if you exclude bonuses, the total was up by 7.8%, which is significantly above the 6.8% inflation. So in real terms, wages are now on the rise, and that causes two problems for the UK. Firstly, when wages are rising at these sort of levels, it's very difficult for the government to bring those levels back down, because the UK still has a high level of unionisation, and there have been a lot of strikes over the course of the last 12 months, particularly from public sector workers such as teachers, university lecturers, doctors, nurses and rail workers. But in addition to what's happening with wages, the UK also now has a major problem with regards to its pension bill. Because in 2010, the UK government introduced what was called the TRIPLE LOCL, which ensures that pensions rise at the best possible rate. And this is linked to what's happening with wages. And just to stir the pot a little further, the unemployment data that's just been released for the UK shows that unemployment is now on the rise and is at the highest rate that it's been for more than 2 years. So in today's video, I'll have a look at the data on wages. We'll go through the details of exactly where we are. We'll then have a look at what's happening with unemployment. I'll talk you through what's going on with pensions, exactly what the triple lock is, and what this means for the cost base for the UK economy. We'll have a look where the UK is currently with regards to inflation and interest rates, and what the likelihood is of another interest rate rise coming through in September. We'll then talk about housing, because that's closely linked to what's happening with interest rates and also the economy. And then finally today, I'll provide you with my summary as to what I think is likely to happen in the UK over the course of the next 3 to 6 months. Now, before we get started on all of that, I'd like to say thank you so much for all of the really great comments that you've all been leaving in the section below with regards to the latest format, me being back on camera. It definitely seems to be popular, so I'm going to stick with this format for the foreseeable future until everybody starts writing lots of comments saying that they don't want to see me on screen. But if you would like to see more videos like this and a bit more insight and a bit more relaxed chat, then check out my Patreon page where you'll find videos that are not posted onto YouTube. However, if you don't like Patreon and you'd like to support the channel, you can find links below to buymeacoffee.com or YouTube super thanks and membership. This chart shows the movement in average weekly earnings in the UK over the course of the last 12 months. And the scale on the right hand side of this chart goes from 5.5% increase at the bottom to 9% increase at the top. And what this chart shows is that over the course of the last year, the minimum growth in wages has been 5.8%. However, in July 2023, the figure has been recorded at 8.5%. And if you look at the trend, there's been a marked increase in wage growth over the course of the last 5 months. In March 23, the annual rate was 6.2%. It increased to 6.8% in April, 7.2% in May, 8.4% in June, and has now risen to 8.5%. And if we expand the chart out to show what's been happening with wage growth over the last 10 years, you can see that the current rates of increases are significantly higher than have been seen historically in the UK. And this represents a problem for an economy that is trying to keep inflation down to 2%. And if we compare that trend to what's been happening with inflation, you can see that over the last 5 months, inflation has actually been coming down. It's decreased from 10.4% in February to 6.8% in July. Now, clearly from the Bank of England's point of view, their primary target right now is to bring inflation down to the target level of 2%. However, if you're a union boss and you're negotiating pay settlements for all of your workers, you're trying to get their wages increased by as much as possible. And you'll be looking at what's been happening with inflation over the course of the last 12 months. And in fact, many of the ongoing pay negotiations have actually been going on for around 6 months. And 6 months ago, the UK had double-digit inflation. So that was really the benchmark that a lot of union bosses were using to try to get their wages increased by double digits. So we've now got a situation where inflation is coming down, but wages are going up. And this chart looks at both the headline rates of pay increases and also the real increases. The blue line at the top of this chart shows the percentage increase in total pay over the last 20 years. The red line looks at regular pay, so excluding any bonuses that are paid to workers. And the yellow line at the bottom looks at the movement in wages in real terms. So this has been adjusted to take account of what's happening with inflation. And if we look over at the right-hand side of this chart, you can see the 8.5% increase for July that's been recorded in total pay. The actual nominal level of movement was 7.8%, which means that 0.7% of the total increase related to bonuses. But the yellow line at the bottom is really interesting because it shows that for the first time since March 2022, wages in the UK are rising in real terms. So that means that when you take into account what's happening with inflation, workers now have more purchasing power. They have more money in their pocket in real terms. They can buy more things when you take account of the increase in prices. And that potentially creates a large problem for the UK at a time when the government is focused on bringing inflation back down. Because if workers have more cash in their pockets, they're likely to spend more, which is likely to drive prices back up. And when asked to comment on the latest data, the UK Finance Minister Jeremy Hunt said wage growth remains high, but for real wages to grow sustainably, we must stick to our plan to halve inflation, which indicates that the government and the Bank of England are likely to continue with their policy of increasing interest rates. Now, one of the knock-on implications of the increase in wage growth in the period between May and July is that UK state pensions are now likely to be increased by 8.5% in April 2024, as a result of what's known as the TRIPLE LOCL calculation. The TRIPLE LOCL system was introduced by the Conservative Liberal Democrat coalition government in 2010 and states that the state pension should increase every April in line with the highest result from 3 different measures. The first being inflation, as measured by the Consumer Price Index in the September of the previous year, the average increase in wages across the UK as measured in the May-July period, or 2.5%. Now, obviously, in terms of calculating the exact figure, we don't have the inflation results for September 23 yet. We are currently in that month, so we won't know that data for at least another 6 to 8 weeks. However, if you look at what's happening with inflation right now, it has got a downward trend. The latest published figure for July was 6.8%, and it's expected that there'll be a further reduction in August. So as it stands at the moment, we're not expecting inflation to be above 8.5% for September. So that means that the calculation would use the wage increase of 8.5% that's been recorded for the period to July as its metric, and therefore pensioners should get an increase of 8.5%. Now, in terms of the impact on the UK economy, this chart shows the cost of the UK state pension dating back to 1987. And in terms of the way this bar chart has been constructed, the blue section, which represents the vast majority of the cost, represents the actual payments under the state pension. The yellow section represents housing benefit, and the orange section represents pension credits. And the last 2 of those are means tested, so only the poorer pensioners actually receive those. And what this chart shows is that in the current financial year, the total cost of UK pensions is 110 billion. However, that's now forecast to increase to 124 billion in 2024 and 135 billion in 2025. So that obviously represents a significant increase. And in terms of what that means in GDP, it's around 5.5% of the total GDP for the UK. This chart shows the movement in the rate of unemployment in the UK over the course of the last 12 months. This time last year, the rate of unemployment was running at 3.6%. However, today it's at 4.3%, which is the highest rate that's been seen in the UK for 2 years. And if you look at what's been happening over the course of the last 3 months, there has been a significant increase from 3.8% in April to 4% in May, 4.2% in June, and 4.3% in July. And the rising rate of unemployment is now starting to cause concern because as we're seeing large increases in wages, the 8.5% that we talked about, it's putting more pressure onto employers because employers need to make a profit, and by taking on more staff, obviously they're increasing their cost base, they're increasing their outgoings. And so there is potentially here a dynamic between the increased cost of labour and the reduction in the hiring of people, resulting in higher rates of unemployment. So what you don't want in your economy is for wage growth to get out of control. So we have a situation where the people who are in employment are very happy because they're being paid well and they're getting large increases, but employers are reluctant to take on more staff because they don't want to increase their cost base, and therefore unemployment starts to increase, and that can cause major problems if we have long-term unemployed because the government has to pay those people. There has to be some form of state benefit at some point to be able to provide people with money to live. So there's a really interesting and difficult dynamic to get the balance right, and currently what we're seeing in the UK is a rapid growth in wages and also a rapid growth in unemployment. This chart shows the movement in the rate of interest in the UK over the course of the last 5 years. And the reason I wanted to expand the graph out to 5 years was really to show what the historic rates were before we started to see these rate increases. So you can see that in 2019 and the first part of 2020, interest rates were running at less than 1%. We then saw the marked reduction as a result of the COVID-19 pandemic to 0.1%. However, since the end of 2021, we have seen 14 consecutive rate increases, and the current rate is now sitting at 5.25%. And one of the things that stands out when you look at the shape of this chart is the steepness of the curve. We've not only seen consecutive rate increases, but it's been over a very short period of time. And that takes time to feed through into the economy. I've talked about it before, but it's likely that when rates are increased, it takes around 3 months for the full impact of that to really feed through into people's psyche. It generally takes a month or two of seeing increases in your cost of borrowing before you start adjusting your spending patterns. So when you've got rapid increases happening over a long period of time, that means that people are constantly having to readjust. So there's a lot going on in the UK economy right now. But the problem that consumers have is that the cost of borrowing has gone up significantly, but inflation hasn't come down quickly enough for the Bank of England to be happy. So it's likely that when the Bank of England convenes on the 22nd of September, that they're going to be talking about how to get inflation down and what's going on with wage increases, because the 8.5% wage increase is a major concern. And so they need to bring both the rate of increase of wages back down to a normalised level at the same time as bringing inflation as close to 2% as possible. And the most likely way of being able to do that will be to increase interest rates further. Now, the only caveat right now is what happened to inflation in August. We don't have that data yet. If that data shows that there was a marked reduction in inflation, then there's a possibility that the Bank of England may decide to hold off on the next interest rate increase and see what happens in September. However, if inflation is still high, if it's still above 6%, then I think the Bank of England will push the button, they'll increase rates to 5.5%, and we'll have 15 consecutive interest rate rises in the UK. The monthly house price report for August 2023, produced by the Nationwide, one of the biggest mortgage lenders in the UK, shows that house prices fell by 5.3% year on year, which is the biggest annual decline since July 2009, which was at the time of the global financial crisis. Prices dropped by 0.8% in the month alone, which is the largest monthly fall since March, and follows on from a 0.3% decline in July. And one of the reasons that this is incredibly important to the United Kingdom economy is the high level of home ownership. This chart shows the levels of home ownership in the UK over the course of the last 10 years. And you can see that the UK currently has home ownership levels of around 65%. So that means that around 2/3 of all of the eligible adults actually own their own home. And this is a major thing in the UK. This is something that everybody aspires towards. Everybody wants to have their own property, to buy their own apartment or house and have a mortgage and live happily ever after. And one of the reasons that everybody wants to buy property is that on average, over the course of the last 50 years, there has been a huge increase in the value of property. And if we jump back to the home ownership chip chart, you can see that over the course of the last few years, there has actually been an increase in the percentage of home owners. And one of the reasons for that is that between the global financial crisis in 2009 and the end of 2021, the official rate of interest in the UK was less than 1%. And that meant that mortgages were very cheap. So people could borrow large amounts of money for very little cost. But as we talked about earlier in the video, over the course of the last 15 months or so, we have seen a rapid increase in interest rates in the UK, which has pushed up the price of mortgages. And this chart shows the movement in the average mortgage rate in the UK over the course of the last 5 years. And this shows that in 2019 and 2020, mortgage rates were very attractive, sitting at or around 4%. And in fact, a lot of deals were available in the market at less than 1%, which seems crazy. But the UK has a very different dynamic to countries such as the United States and Canada. In the UK, the most common form of mortgages are short-term fixed rates. So people lock into a rate for 1 or 2 or 5 years. And the way that the mortgage companies build those rates is that they give you a discounted rate at the front end. So you might be able to get the benefit of a 1% mortgage for 2 years, which sounds amazing. But at the end of that 2-year period, your rate will then convert to a much higher rate. And this is one of the problems that a lot of the homeowners in the UK are now facing. This chart shows the breakdown of fixed rate mortgages in the UK, dating back to the start of 2022. And this shows that in 2022 and 2023, the majority of mortgage deals that were agreed were at less than 2% interest, which indicates that these are short-term fixed deals, 1 or 2 years. And if we look at the right-hand side of this chart, you can see the number of mortgages that are coming to the end of their fixed rate over the course of the next 18 months. So a lot of these are at a rate of less than 2%, and the majority are between 2 and 2.5%. And if we now jump back and look at what the average mortgage rate in the UK is today, you can see that it's close to 8%. So people who have bought property who are currently sitting on a short-term fixed rate of around 2% are going to see an increase in their mortgage costs upon maturity of almost 4 times. And obviously that is going to be a major problem because the majority of people who have mortgages, their mortgage payment represents the single largest outgoing every single month. And it's unlikely that the majority of mortgage holders will be able to afford an increase of 4 times in that payment. Most people simply don't have the ability to do that. So what's the summary and conclusion today? Well, I wanted to post this video because the wage data that has now been released is really important because the rate of increase of wages is something that's very difficult to switch up and switch down in the short term. Generally speaking, when you're negotiating wage settlements, you'll look at firstly what's happening with inflation because you want to maintain real value for your income. So you want to make sure that you can buy at least the same amount of goods and services that you could buy this time last year. But you'll also look at what's happening with other pay settlements. So over the course of the last year, we've seen high rates of inflation in the UK, above 10% for a lot of that period. So that's led to a lot of the unions and wage negotiations coming in with very high increased demands, in some cases double digit. And as I mentioned at the start of the video, over the course of the last year, there have actually been a lot of strikes in the UK because some of the bigger unions have been pushing very hard to try to get a very good settlement. And we're now starting to see the impact of those negotiations feeding through into average wages. But the problem that we've now got is that everybody who's currently at the negotiating table will be looking at the average wage growth of 8.5% and thinking that they need to achieve at least that level to prove that they've done a good job for their union members. So we've got a situation where the bar has been set very high for wages at a time when the Bank of England is trying to bring inflation down to 2%, and it's currently at 6.8%. So you've got two different forces pulling in opposite directions here. And the likely outcome is that the Bank of England will do the easiest thing available to it and increase interest rates again in September, because increasing interest rates increases the cost of borrowing, increases the cost of money basically for everybody, and therefore means that people generally will be a bit more cautious. They'll take on less debt, they may decide to cut back on their spending, and overall that reduces demand and therefore brings prices back down. But the problem that the UK has is that a large portion of the population have mortgages. Around 2/3 of UK adults own property, and the vast majority of those people have large mortgages. And unlike countries like the United States, home buyers don't take out mortgages for 30 years. They tend to be a fixed rate of 2 or 5 years. And a lot of those deals are maturing over the course of the next 6 to 12 months. And that means that all of those people will be moving on to significantly higher rates of interest. And this is going to cause a major problem for a lot of people. So the last thing that homeowners want right now are further increases in interest rates. But because of what's happening with wages and the knock-on impact to pensions, as we discussed, the triple lock means that pensions are going to increase by 8.5% in the UK over the course of the next 12 months. That's going to put a further burden onto the state, because the UK government has to fund all of those pensions. And so that means that they're going to need to do something about this to bring those pension increases down at some point in the future. If pensions continue to increase at 8.5% over the next few years, that would put a further strain on the UK budget. So we've got a situation right now where we've got lots of different forces pulling in opposite directions, and it's going to be really difficult for the Bank of England to be able to sort this out. And the most likely scenario over the course of the next 3 to 6 months is that we will see more interest rate increases. That's going to lead to a reduction in spending and a reduction in GDP in the UK. And therefore, there is a very real chance over the course of the next 6 to 12 months that the UK could be pushed into recession if it continues its goal of bringing inflation back down. And one of the critical pieces of data that we're now waiting to see is what happened to inflation in August. That data will be released around the middle of September, and everybody in the UK will be hoping that inflation has come down significantly from 6.8%, because that's really the only chance that the UK has of avoiding further rate increases. If inflation hasn't come down significantly, then the Bank of England really won't have much choice but to increase interest rates further. That's going to put further pressure onto most of the workers and consumers in the UK. It potentially could fuel further wage demand increases. So we get the wage spiral, whereby wages continue to go up at a time when you're trying to bring inflation back down. Becomes a really difficult conundrum to solve. So it'll be really interesting to see those inflation figures when that data is released, and what the reaction from the Bank of England is at their next meeting on the 22nd of September. So hopefully you've enjoyed today's episode, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.